Fundless sponsors and the self-directed IRA option. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. On today's podcast, AdBits, we are going to discuss, at least I'm going to discuss, the emergence of fundless sponsors and the ability to use a self-directed IRA to invest in these deals. So fundless sponsors have become a more popular approach lately to just do deals. Why? Because you don't need to raise a whole fund to do a deal. What a fundless sponsor means is essentially you're doing deals instead of funds. So you find company A, you want to buy company A. Instead of raising a $500 million fund to buy 10 companies, you set up a deal, not a fund, but basically an entity with investors, whether it's friends and families or other investors, to only focus on this one deal, right? And then the deal happens, you can then move on to the next deal. So the difference between a fundless sponsor and a fund is the fund is raising money, it has the money under management, it then is getting this 2 and 20, and it has time to then find deals. A fundless sponsor will say, hey, I want to buy or invest in company A. It will do the diligence on company A. It will then set up a deal with the owners, shareholders of company A. And it will then take the deal and start marketing that deal to investors. And the investors will then invest in an entity that invests solely in that deal. So it's not a fund where your investment is in the fund, which mean it could have interests in different businesses. No. Here, you as an investor in this fundless sponsor deal only will invest in this particular deal. So why is this more popular in the last year or so? It's because it's harder to raise money for a fund now. Okay, just money's tighter. It's harder to raise big money for a fund. But there is money on the sidelines, and there are plenty of investors that's willing to invest 100 grand or 200 grand or 500 grand in a particular deal they like. They may not want to tie up their money in a fund in fintech or insurance or whatever the industry is, and say, we're going to wait a few years to find the right opportunities, versus, hey, we're raising the money, here's the deal, here are the terms, we can close in 30 days, you're going to own X percentage of this deal, and that's all you're going to own. And from a promoter standpoint, it's also beneficial because with a fund, the advantage of a fund clearly is you have the money already there. So if you need to do a deal, you can execute quickly. You're also getting fees on the money that you've raised, assuming it's been committed or not. But what happens in a fund is if you have 2 good deals and 2 bad deals, the fund is flat, right? Or depending on the returns get reduced by the bad deals. Whereas a one-off, when you do a fundless sponsor deal, you're only getting measured on that deal. So this deal could work and that deal may not work, but the deal that doesn't work won't have any impact on the deal that worked from a return standpoint. So I guess you can go to other investors and say, hey, look at this deal. Right? We tripled our money. It was a great deal. And you could ignore the bad deals. Versus a fund, you're going to be able to identify all the deals in that fund. So the biggest reason, again, why fundless sponsors have become a popular way to raise money to do deals is it's harder to raise big money now based off higher interest rates and just tightening of investors' money, especially in the private equity, venture capital, and real estate world. Valuations have some uncertainty, and it's just harder to get a fund off the ground. But one-off deals are much easier to do. Hey, I like this company. It's an AI company, or it's doing fintech, or it's insurance tech, or it's medical, whatever it is. I can get comfortable with this one deal. I diligence this one deal. I get it. I understand. I want to do it. And then the self-directed IRA world is a great source of capital for those deals. So if you're listening to this podcast or watching on YouTube and you're looking to do a fundless sponsor deal of 5 million, 10 million, 15, whatever it is, don't forget that IRAs with $13 trillion of IRA money out there, most Americans are rich IRA and poor outside their IRA. Just the way it is. And it's smart. If you're going to save, it's much smarter to do it in an IRA or 401k because you could take advantage of compounded returns. Your money grows faster when it's not subject to taxation. It's the eighth wonder of the world, according to Albert Einstein. So it makes sense if you're going to have a bucket of savings that it is in an IRA or 401k versus your personal accounts. So if you are looking to raise money on a deal, you should be focusing on IRA money. Generally, up to 25% of the deal could be IRA money without triggering what's called the plan asset rules. So if you're raising 10 million, you can get $2.5 million of IRA money. It's helpful, right? People are more likely to take chances with their IRA just because you have a longer horizon, right? You don't need the money tomorrow. If you're in your 30s, 40s, or 50s, you don't necessarily mind getting locked up for 5 years on a private equity deal because you can't touch that money anyways. Now, of course, you want the returns to be exceptional, but you're okay from a lockup standpoint a lot more than if you use personal funds where you're like, hey, I don't know, I may need the money, God forbid, in a year or 2 years. Like, I don't want to be locked up for 5 years on this private company deal. So as a Fundless sponsor, promoter, you definitely want to be looking at IRAs. And as an IRA investor, it actually marries very well with these Fundless sponsor deals. Of course, assuming you've done your diligence, you like the deal, you think you can make money, you're probably more accepting of being locked up than you would of personal money, since you're likely not going to be able to use those IRA funds for many, many, many years. So it's a really, really good working relationship between Fundless sponsored deals and IRA money. So it's kind of a win-win for both sides. The promoter's looking to raise money. A lot of investors, as I mentioned, are poor personal, but rich IRA, or rich 401k, which is the right way to save. And then those folks just need to be educated that, hey, you can use your IRA or 401k to invest in this Fundless sponsor deal. And you could, shelter your gains from tax if it's in a Roth, or depending on the deal, there's tax optimized solutions for investing. And that's where IRA Financial comes in, because not only can we help these promoters raise the money, but we can also help structure the deal so it's tax optimized for the IRA investor, whether it's equity, debt investment using a blocker. There's so many different solutions we have to make sure that we could help our clients get tax deferred or tax-free gains on the company investment. So just wanted to introduce the concept. A lot of people don't know what Fundless sponsors are. They're like one-off deals, another way of thinking about it. Your buddy, your neighbor is trying to raise $6 million for a real estate project. That's a Fundless sponsor deal. He doesn't have a fund, assuming. He's just doing a one-off deal to raise money. And what's happening now is a lot of these Fundless sponsors are doing one deal, they're liking it, and then just doing more and more of the same things without setting up a fund. Because again, it's easier to just have different terms, different economic terms for each deal. Maybe in this deal, there's going to be different warrants or different upside that's going to be provided to the promoter or the investors that you may be able to trade off on another deal. So it just gives the promoters more flexibility. The downside, obviously, is you don't have the cash at your disposal. So every deal, you got to go out and chase it, which is why if you are listening to this and you're a promoter, please consider the self-directed IRA marketplace. There's $13 trillion of IRA money. There's over $600 billion of rollover money from 401ks each year. With people changing jobs on average once every year and a half to 2 years, there's a lot of money moving between 401ks and IRAs, and a lot of great opportunities to take advantage of the IRA money to help fund, which hopefully are really exciting, promising deals, whether it's in private businesses, credit funds, real estate, hedge funds, venture capital, whatever you're investing in. The idea of just doing a deal for that specific deal without having to set up a whole fund is attractive in 2024, a lot more than in 2020 when everyone was raising funds. It's a lot harder now. So doing one-off deals make it easier. It gives the promoters more flexibility to kind of play around with the economic terms, maybe give investors a better upside return on a deal that's harder to fund, and maybe less so on a deal that's been easier to fund. So they just have a little bit more flexibility and discretion when they're structuring deals with the Fundless sponsor arrangement versus a fund. So that's it for today's podcast. Hope you enjoyed it. Interesting topic. I've been hearing a lot more and more Fundless sponsor deals. We're helping a lot of our clients. We're building an amazing B2B platform, which should be live in the next couple of weeks. We'll basically do all the admin and back office for these Fundless sponsors, allow them white glove service, VIP service to help their investors onboard, allow them to track where the investors are in the process, send out reminders to investors to fund their account, which will make the promoter's job a lot easier to focus on the deal instead of chasing people to fund the deal, which is something that will help with, and obviously take care of all the IRS annual administration reporting, which is one less thing you as a business person have to deal with. So that's it for today's podcast. Hope you guys enjoyed it. If you guys have questions, let us know. Please, if you enjoyed it, please review it, give it a good rating, review it, thumbs up. All that's appreciated. If you want to watch it, you can on YouTube, where we drop 3 videos a week in a YouTube live. And I also post all the podcasts I do, the AdBits, which is this one, Ad Mail, and Adam Talks. So if you are interested in learning more about self-directed retirement accounts or tax solutions, alternative asset strategies, current events, new tax cases, new IRS rulings, anything involving tax, alternative assets, or retirement accounts, it's the best place to be on the web. There's no other YouTube channel that's going to give you this content in this updated format than IRA Financial. So all for you guys. I hope you appreciate it. If you don't, that's cool. I love doing it, so it doesn't matter. And I know, if one person a day learns something and becomes a better investor, that's my goal. Ultimately, we'll get a self-directed IRA nation of millions and millions and millions of Americans that want to take control of their retirement future. They want investment freedom, and they want to become tax-free millionaires at retirement. That's my goal, and I'm not going to stop until I do it. So thanks for hanging out and being part of this journey. Have a great day, and I will see everyone again next week. Thanks.